What's going on, guys? Today we're going to be talking about Johnson & Johnson. We will start by taking a look at their stock chart and how they have traded over the last few years. Then I want to go over some issues that are facing the company moving forward. We will also take a look at their dividend and what the growth could look like over the next 10, 20, and even 40 years. And finally, we will leave off by looking at valuation as well as earnings growth over the next couple of years. So if you enjoyed the video, make sure to drop a like down below. And if you want to see more videos like this one, subscribe. Let's start by taking a look at Johnson & Johnson's stock chart. We could see that over the last year, the stock is down almost 15%. And over the last 5 years, it's up only 6%. However, if we look at it from its lows back in 2019 of around $127 to where it hit its highs at, it was up around 42%. However, from there, it's traded down in a major way over the last year or so, down almost 17-18%. A lot of people say do not try and time the market. However, it is important to buy at the right time, especially if you're picking individual stocks. And what we can see just from looking at Johnson & Johnson is at the end of November in 2018, the stock was trading at almost $150. And from there, over the last 5 years, it's only gained 6%. However, if we had bought just a month later, in December of 2018, when the stock was at $127, we can see that our return over the last 5 years would be triple that 6%, all the way up at 18.5%. And this speaks volumes about buying the dip. And we can see that over the last year, the stock is down almost 15%. So we are clearly in a dip right now, and this could be a good buying opportunity for Johnson & Johnson. And personally, when I buy into companies, I like looking for companies that are going through something that I don't believe is going to affect the underlying business. And for Johnson & Johnson, they are going through some lawsuits around their talc powder. And earlier this month, we saw them settle a couple of those cases. However, they are facing much more. We can see that they are facing over 50,000 lawsuits around their talc powder. The thing is, even with these lawsuits going on, Johnson & Johnson has a very stable business. They work directly with a lot of hospitals and doctors and build out a lot of research around their technology that allows them to stay very entrenched and make it even more difficult for new players to come in and disrupt them. And they have two main focuses within their business: innovative medicine as well as medical technology. Innovative medicine is just how it sounds. This is going to be anything that someone is going to take to actually treat either their symptoms or a sort of illness that they may be experiencing. So it could be therapeutics around oncology, immunology, or it could be something as simple as an aspirin. And medical technology is anything used by doctors in the hospital. So we have x-ray machines, we have different sort of surgical utensils that are used throughout procedures, anything along those lines that Johnson & Johnson is developing. Both of these sectors, medical technology as well as medicine, have a lot of research and development and need to be really vetted before they can actually be rolled out on patients. And we can see how those actually affect their revenue numbers. So 55% of their revenue is coming in from innovative medicine. They have around 29% of their revenue coming in from medical technology, and then another 15.7% coming in from consumer health. And one of the ways Johnson & Johnson returns value to their shareholders is through a dividend. And they recently announced that their third quarter dividend would be $1.19 per share. And they increased this dividend back in May, where they went from $1.13 all the way up to $1.19 per share. And Johnson & Johnson is known for increasing their dividend. They have increased their dividend every year since 1963. So for the past 60 years, they have been increasing their dividend, and this qualifies them as a dividend king. And we can see from this chart how their dividend has grown since 1990. We can see that back in 1990, the dividend was sitting around 25 cents and has grown all the way up to around $4.50 per year. And if we look over the past decade, we can see that their dividend has been growing at a rate of 6.3% every year. However, when you look at their payout ratio, it's currently sitting at 87%. And what a payout ratio is basically what percent of their earnings they are paying out as a dividend, and 87 is a very high number. A lot of companies that you look for as stable dividend growth companies sit around 60 to 65%. Ultimately, what this means for the company is they need to focus on growing their revenue as well as EPS numbers to be able to maintain the dividend growth that we have been seeing. And ultimately, if we're able to see Johnson & Johnson continue to increase the revenue and EPS numbers, this could be a very lucrative company. So what I want to do next is I want to take a look at that dividend and how it could grow over time. Here we have Market Beats Dividend Calculator. And what we are doing here is we have it distributed every quarter. We have it set on DRIP, which means we're reinvesting the dividend. We have the starting principal of of $10,000, $0 being contributed yearly. We have a tax rate of 15%. We have a dividend yield of 3.16, which is Johnson & Johnson's current dividend yield. We have an average growth rate expected of the dividend of 6%, and then share appreciation of 3%. And then we're investing over a 10-year time period. So here we could see what happens after 10 years. We could see that the balance in the portfolio has grown all the way up to $18,000. This is a total return of 80.93%, an average annual return of 6.11%. Your annual dividend income at the end of this time period would be $773. We would have a total dividend payment over those 10 years of $4,811, and our yield on cost at the end of this time period would be 7.06%. Now, if we increase this number to 20 years and we calculate this, we can see that the ending balance now jumps up to $36,000. We have a total return of 261% and an average annual return that jumped up to 6.6%. Our dividend annual income at this point would be just over $2,000. We would have a total dividends paid of $17,000, and our yield on cost would be sitting at 18.6%. And you start really seeing the effects of compounding when you increase this to 40 years. When we increase to 40 years and calculate, we can see that our ending balance would jump all the way up to $223,000. Our total return would be 2,131% with an average annual return of 8%. Our annual dividend income would now be sitting at $23,000 a year with a total dividend payments over those 40 years of $167,000, and our yield on cost would be over 200%. And this is really when the compounding effect gets really interesting, because what we can see is that our annual dividend income is now double what we originally put into the company. And again, there is no contribution being added over this time period. So just naturally sitting there and growing over time, you are now receiving double the money that you put into this investment originally. And obviously $23,000 is not a lot of money, especially when you think about it 40 years down the road. However, if you build out a portfolio that has a 3% dividend yield and it's growing around 6%, and you diversify and you build it out to around $50,000, we can see that that dividend income now jumps up to $115,000. The last couple things I wanted to look at are valuation and EPS numbers. And for valuation, we can see that the forward P ratio right now is sitting at a year low of 13.95, and a year ago they were actually trading all the way up at around a 17 forward P ratio. And for EPS numbers for 2023, analysts have an average estimate of $9.21, a low of $9.10, and a high of $9.27. For 2024, we can see that the numbers grow slightly with an average EPS estimate of $9.86, a low of $9.33, and a high of $10.09. And this average EPS number from 2023 to 2024 is projecting growth of just over 7%. So personally, I've actually owned Johnson & Johnson in the past. However, I ended up selling out of the position just because I thought there were better opportunities in the market. The issues right now with this company are the lawsuits that it's facing, as well as its high payout ratio. Johnson & Johnson is a dividend company, and most investors in the company are only there because of the dividend and the strong growth that they have shown. If we see Johnson & Johnson show weakness, especially in terms of potentially cutting their dividend, then we will see the stock price fall in a major way. And that is the biggest concern with J&J, is if they were to do that, the stock price would fall very significantly just because of their investor base and what they are looking for out of this company. So personally, I am not buying into this company right now. However, if it were to fall another 10 to 15% over the next 6 months or so, then maybe I'd relook at J&J and see if it is worth buying. But right now, I'm more just waiting to see what happens with this company around a lot of their lawsuits and their EPS and revenue numbers. But with that said, make sure to never buy a company just because someone talked about it on YouTube. Do your own research, look into companies that meet your risk tolerance as well as your time horizon. And if you enjoyed the video, drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And I appreciate you guys watching these videos. I appreciate all the comments down below. If you want to see me go over any companies, make sure to drop those down below and I will do a video on them. Thanks again for all the support, guys, and have a wonderful rest of your day.